Yes, students. Now let us learn the tax rates applicable for assessment year 26-27, that is as per Finance Act 2025. Guys, in this chapter, there are few amendments, that is the tax rates under the default regime or the rebate under section 87A. So please be careful with it. And whenever I am covering that particular topic, I will also mention that it is an amendment. I have also highlighted those topics which are amended, which is applicable for your exams in italics in my revision material. So before I start with tax rates, guys, let us just mark whatever section we have covered in the previous chapter in the first page of our revision book. So come to the first page where I have given the list of sections. We have marked till section number 4, which we have covered in first chapter. Then we covered section 5 along with section 7 and 9 in chapter 2. Then we also covered residential status as per section 6, guys. And especially residential status is a very important topic for you in your exams. That too, residential status of individual. So totally there are 7 subsection under section 6. I will just give you a shortcut to remember it. Come to chapter 2, guys, where I have given the list of sections under section 6. That is the subsections. Yes. So section 6 subsection 1 has a basic conditions for individual, guys. So individual means how many person? Only one person. So you can remember like that. Section 6 subsection 1 talks about the basic conditions applicable for individual. Then once it is satisfied, we need to go to section 6.6 and check the additional condition to see whether they are ordinary resident or not ordinary resident. So there are two conditions and both the condition has to be satisfied by an individual in order to be ordinary resident. So there are two 6 here. 6 subsection 6. Yes, sir. So if an individual is not covered under section 6.1 because of number of days of stay in India, then we can also go and check section 6.1a, which tell an Indian citizen who is having total income other than the income from foreign source more than 15 lakh and not paying tax in any other foreign country, Indian government is ready to adopt them as deemed resident. Clear? So this talks about section 6.1a talks about deemed resident where the government is ready to adopt. So A for adopt. Try to remember like that, guys. Yes. Then section 6 subsection 2 talks about the residential status of HUF, AOP and partnership firm. For any of this organization or family, at least two members has to be there, no? Even for a family, at least two people has to be there. Yes, sir. Even for a partnership firm, at least two partners has to be there. Yes. So section 6 subsection 2, guys. Then section 6 subsection 4 also has same criteria, but it covers different set of people. So section 6.2 and 6.4 covers two separate set of people, but both are having same criteria. Got it? So you can remember like this. 2 subsection 2 covers HUF, AOP and partnership firms. No? Into 2, the second set of people is covered under section 6.4. But the criteria is the control and management is partly or wholly in India, then they are said to be resident in India. Then coming to section 6.3, which talks about residential status of companies. Companies start with C. C is the third alphabet. So section 6 subsection 3, guys. Then the last one, that is 6.5. 6.6 I already covered. So 6.5. Guys, they are telling one residential status for all sources of income and one residential status for each and every year. Should we check the residential status for each and every year? Yes. Now assume I have income under all the 5 heads of income. The residential status will remain same for each head of income, guys. So they are telling one residential status for all sources of income. No? Yes. Easy to remember. So totally how many heads of income is there under the Income Tax Act? Totally 5. So section 6 subsection 5. Hope it was helpful for you. Yes. And if you can remember without shortcut also, that would be great, guys. Yes. Now we will begin with the tax rates topic. Rates of tax. Income tax is to be charged at the rates fixed for the year by the annual Finance Act. And which is the Finance Act applicable for your exam, guys? Finance Act 2025. Please be careful. There is also a Finance Act 2026 which is already implemented, but nothing contained in that will be applicable for your exams, guys. It is applicable only from the exams to be conducted on May 2027 and onwards. Okay, sir. And tax rates depends on various things. What are those? One by one. Category of person, that is whether I am an individual, company, partnership firm, because for each category of person, the tax rates are different, guys. Okay. Then amount of income. Normally, income tax is progressive in nature. Higher the income I earn, higher will be the tax rates, guys. Yes. And if it is more than certain specified limits, then the assessee will also end up paying surcharge along with health and education cess. Health and education cess will anyway be there always. Then residential status of a person, especially for individual who is opting for optional scheme. If the age is 60 or more or 80 or more, then they will get a benefit of higher basic exemption limit, guys. Okay. So residential status and age will matter there. Got it? Yes, sir. Age obviously is only for individuals, not for others. Type of income, that is whether the assessee is earning special income or normal income. So there are two category of income for income tax purpose, guys. Why? Because there is different rate applicable on different income. Clear? Now, what is special income? First of all, I have given the list here below. You can just have a look here. Okay, so what are special incomes, sir? Whatever is covered in your syllabus, we will talk about it, guys. Yes. Long-term capital gain under section 112 or 112A, and short-term capital gain under section 111A, and coming to the casual income. So capital gains will always be taxable under the head capital gains. Okay, there is a specific head called capital gains, which is the fourth head of income. Then casual income, which will be taxable under the head income from other sources, as per section 115 BB or 115 BBJ, that is winnings from online games. Then if there is any undisclosed income also, then even that is called as special income, which is taxed at 60% plus 25% surcharge fixed plus 4% cess, guys, as per section 115 BBE. We call this incomes as special income. So first, what do we need to check is, we need to always calculate the tax liability of any assessee on total income. First, check whether total income includes any special income. If yes, then calculate the tax on that. So, what is the tax rate applicable on special income is, irrespective of the scheme followed by the assessee, whether default or optional, the tax rate will remain same under the Income Tax Act. And the tax rates applicable on special income is given in Income Tax Act, guys. Is that clear? So, irrespective of the category of person, irrespective of the scheme followed by them, the rate remains same. Yes, sir. And it is given in the Income Tax Act under the respective sections, which I have mentioned here. All this is a part of Income Tax Act. Okay, sir. What about normal income? Then normal income is taxable at normal rate as applicable to the assessee. It can be a slab rate or it can be a flat rate. For individuals and all, it is slab rate, whereas for company, partnership, firm and all, we call it as flat rate. One single rate is there. Okay. And these rates are given in which? Annual Finance Act. And there is no specific section for it, but it is a part of Annual Finance Act, guys. And these rates will vary depending upon the scheme followed by the assessee. If the assessee is following default scheme, then the rate would be different. If the assessee is following the optional scheme, then the rate is different, guys. So you have to be careful with respect to normal income. Okay. So what are the tax rates applicable with respect to each of this income we will learn. But before that, what's the format to compute tax liability? I've given here. And guys, in my revision material, wherever I have given any table or calculations in green color like this, that means you have to stick to that format. Please don't change anything as per your convenience. Got it? Yes, sir. So we are supposed to calculate the tax liability of the assessee on the total income. First, check whether total income includes any special income. If yes, first calculate tax on special income at special rates, guys, as per the respective section which I just now mentioned. I will discuss each of those sections also later. Okay. Then whatever is the balance income, which we call it as normal income, calculate the tax at normal rate, which is either slab rate or flat rate as applicable to the assessee. When we add up both of this, we get gross tax liability. You might also ask, sir, what if assessor doesn't have any special income? Then whatever is the total income will be taxed at the normal rates, guys. That is either flat or the slab rates. Yes, sir. So once we derive gross tax liability, especially if it is a resident individual, please pause for a second and check whether rebate is available. Rebate is available if the total income of a resident individual is up to 5 lakh under optional scheme or up to 12 lakh under the default regime, guys, which we will learn later. So if rebate is available, please provide the same, but it is available only for resident individual. Please be careful. Yes, sir. Then if at all if rebate is available, we will reduce it. Okay, it is a benefit given to the associate. Then after that, if figure is still positive, then we will add 4% health and education cess and pay it to the government. Sir, assume our tax liability was 20,000. Entire 20,000 is available as rebate. Then our final tax liability or total tax liability would be nil, guys. This figure would be nil. Got it? Yes, sir. Then in few cases, surcharge can be applicable. Sir, when is surcharge applicable, guys? It is an additional tax which is applicable to the assessee only if his total income is more than specified limit, like 50 lakh, 1 crore, 2 crore, 5 crore, 10 crore. Is that clear? And here in the format, I have given both rebate as well as surcharge, but both cannot come in the same case, guys. As I already mentioned, rebate is available only when the total income is within 5 lakh or within 12 lakh. So obviously, surcharge will not be applicable in that case. And when surcharge is applicable, rebate will not be available, guys. Yes, sir. Fine. So surcharge should always be calculated on gross tax, guys. So when surcharge is applicable, as I told you, this step will not come. Okay. Yes. So surcharge assume is at 15%. So 15% has to be levied on this figure. Is that clear? Yes, sir. So once we add surcharge, then we will get tax liability after surcharge, which is nothing but gross tax plus surcharge. For that, we should always add 4% health and education cess. Health and education cess will always be there at 4%, guys. Is that clear? This is the format to compute the tax liability. And if at all, if assessee is eligible for any TDS or advanced tax credit, from this we will reduce and the final tax to be paid, we will calculate. TDS, TCS concept and all, I will cover it later as a separate chapter. That is why I have not included here. Okay, but if at all, if TDS or advanced tax or TCS credit is available to the assessee, we have to reduce it here and we need to calculate final tax payable. Final tax payable. Is that clear? And the final tax payable or the total tax liability has to be always rounded off to nearest to 10 rupees as per section 288B, guys. Okay, sir. So whatever I just now discussed is only about the format. Now let us get into the tax rates. And guys, you are supposed to remember all this tax rates. So please be attentive. Look here, come on. Yes, sir. So what are it? First, we will discuss the tax rates applicable on normal income. Then we will discuss the tax rates applicable on special income, guys. Yes. So first category of persons, that is individuals, HUF, AOP, body of individuals and artificial juridical person. Guys, they have two options. What are those two options? I will just discuss it here. I have prepared a table here. Yes, guys, they have two options. One is default scheme, which is available under section 115 BAC. And if they don't want that, they can opt out of default regime and follow optional scheme. So optional scheme is like a second choice for them. Okay. For whom and all, guys, I repeat once again, for whom and all this is available, individual, HUF, AOP, BOI and artificial juridical person. Yes, sir. Fine. So where is default scheme covered? Under section 115 BAC of Income Tax Act. Whereas optional scheme is covered in Finance Act, there is no specific section for it. Okay, sir. The tax rates under the default regime is kept lower, whereas under optional scheme, it is little higher. Little higher. We will understand the rates and all little later. Okay, but I'm just explaining the difference between both the schemes now. Okay. Whereas there are various deductions and exemptions available under the optional scheme. Whereas if the assessee is following default regime, most of the important deductions and exemptions are blocked, guys. Blocked means not available. And what are the exemptions and deductions which are blocked under section 115 BAC? I will not be covering it in this chapter. I would be covering it under the respective head, guys. At the end of each head and deductions chapter, I have given the list of exemptions and deductions which are not available if the assessee is following the default scheme under section 115 BAC. Got it? So I will cover it under the respective chapter. Then the total income under the optional scheme will be lower. Why? Because the assessee can claim all the exemptions and deductions provided he has satisfied the conditions given under the respective section. Yes, sir. Whereas those deductions are not available under the default regime. So automatically the total income figure will shoot up under the default regime. Okay. So coming to the choice. If assessee is not doing anything, if he is not opting out, it is always understood that he is following default scheme, guys. It is like a default settings in our mobile phone. If I want, I can go and change it. If not, it will remain same. Yes, sir. No, sir, I don't want to follow default scheme because you are not giving me any exemptions and deductions. So I want to follow optional scheme. What can I do? I can opt out of default regime and I can follow optional scheme. Optional scheme is also called as regular provisions of the Income Tax Act, guys. Normal provisions or regular provisions. Yes, sir. Now, sir, how many times can I switch between default regime and optional regime? Depends on whether you have income under the head PGBP or not, which I have given here. If an associate doesn't have any income under the head PGBP, that is, he doesn't have any income from business or profession, then every year he has a freedom. He is a free bird. Every year he can compute total income and tax liability under both the regime and check where it is lower, where the tax liability is lower, and accordingly he will follow it. Accordingly, he will follow it. Sir, when can he intimate this to the income tax department? At the time of filing the returns. At the time of filing the returns, there will be an option. You can just choose it. Whether you want to follow default scheme or optional scheme. Actually, default scheme will be there automatically. If you don't want to follow it, then you have to opt out. Got it, guys? Yes. And while filing the returns, if you choose the default scheme, automatically all the deductions and exemptions will be blocked. Even if you want to go and claim it, it won't be possible. But for academic purpose, you have to remember which are the exemptions and deductions which are blocked under the default regime, guys. Questions would be asked on that. Okay. Sir, what if assessee is having the income under the head PGBP? This is important. If the assessee is having the income under the head PGBP from any business or profession, first is they will be following default scheme. And if they continue to follow default scheme, no problem. In any year, if they want to go to optional scheme, can they go? Yes. They can opt out of the default scheme and they can follow optional scheme. And even in the subsequent year, they will follow optional schemes. Clear? And they felt bored with optional scheme. Can they come back to default regime? Yes. And once they come back to default regime, even in the subsequent year, they have to follow it mandatorily. Sir, I want to go back to optional scheme. Is it possible? No, sorry. No, it is not possible. Is that clear? It will be possible only when associate is shutting down his business, closing down his business, guys. If you want to continue with this business or profession, then once from default to optional event, then from optional to default, he can come back, but he can never go back to optional. He can never go back to optional. Sir, what? After 5 or 10 years, he is shutting down his business. He doesn't have any income under the head PGBP. Now, does he has a freedom to go back? Yes, because he will fall under this category. When associate is falling in this category, he is a free bird, as I already told you. Got it, guys? Yes. Sir, if question is silent in the exam, what do we follow, sir? Guys, follow default scheme. They would have given it in the question which scheme the assessee wants to follow. If by chance, if question is silent, please follow default scheme for the calculations. Yes, sir. Fine, guys. So let us see the tax rates. Any individual, whether resident or non-resident, irrespective of the age, every HUF, every AOP, BOI, and artificial juridical person, what is the tax rates applicable for them on normal income? Guys, for special income, what is the rate? We will see later. Any person who is earning the special income, the rates remain same. Whatever we are learning now is the tax rates applicable on what? Normal income, which we call it as normal rates. Okay. Gross rate, base rate, everything is one and the same, guys. Yes. So for this set of people, I call them as in simple slab rate assessee, guys. Why so? Because for them, slab rates are applicable. So please be attentive, guys. This is an amendment. I have highlighted in italics. Please be careful. There is a change here. Okay, so what is the tax rate, sir? Up to 4 lakh, we call it as basic exemption limit. There is no tax. Then from 4 lakh to 8 lakh, it is 5%. Then 8 lakh to 12 lakh, it is 10%. Then 12 to 16 lakh, it is 15%. 16 to 20 lakh, it is 20%. Then 20 to 24 lakh, it is 25%. And more than 24 lakh, it is 30%, guys. Is that clear? Yes. As this is an amendment part, I just want to discuss one question on this from my question bank. If you want to refer to this question bank, it is available on our website under the free resources. You can just download it. Yes, question number 1 is on default scheme, guys. Mr. X has a total income of 26 lakh. for previous year 25-26, comprising of income from house property and interest on FD, guys, both being a normal income. So entire total income is a normal income. So let us calculate the tax under default regime quickly. Please observe, please observe. I will be going little fast, guys. This is not the regular class. So obviously I need to cover the entire topic within a short period of time. Yes. So please support me. Up to 4 lakh, it is nil because it is called basic exemption limit. Then 4 lakh to 8 lakh, 5%. Find out the difference between upper limit and lower limit. 8 lakh minus 4 lakh, you will get 4 lakh into 5%, 20,000. Then 8 lakh to 12 lakh, it is 10%. So 12 minus 8 lakh, you will get 4 lakh again into 10%, 40,000. Got it? Then 12 to 16 lakh, 15%. The amount will be 60,000. Then 16 to 20 lakh, it is 20%. So 80,000. Then 20 to 24 lakh, 25%. The amount would be 1 lakh, guys. Okay. So more than 24 lakh, it is 30%. So what is the total income? 26. So 26 minus 24, we will get 2 lakh into 30% will give us 60,000. So what is the gross tax liability of an assessee of an individual who is Mr. X? It is 3,60,000. So is the rebate available? No, sir. Is surcharge applicable? No, sir. We will discuss both these topics little later. Then 4% health and education cess will be applicable on 3,60,000, which will come to 14,400. So the total tax liability of the Mr. X, who is an assessee, is 3,74,400 under the default regime, guys. Is that clear? And it is actually easy. It is actually easy now. For every 4 lakh increase in income, guys, tax rate will increase by 5%. Up to where? Up to 24 lakh. Clear? And the tax liability will keep on increasing by 20,000. For every 4 lakh increase in income, the tax rate will increase by 5% and the tax liability will increase by 20,000. You can see. Will keep on increasing by 20,000 extra. Okay. But up to 24 lakh. Clear? Over and above 24 lakh, any amount, 30%. And if at all, if there is any multiple choice questions asked and all on this, it is very easy to calculate, guys. Up to 24 lakh, you will get 3 lakh tax liability. Up to 24 lakh, 3 lakh. Over and above 24 lakh, what is the tax rate? It is 30%. For example, assume the total income of the assessee is given in the question 40 lakh. How do you calculate the tax liability quickly? Assume it is a multiple choice question. So up to 24 lakh, it is, sorry, up to 24 lakh, it is 3 lakh. Okay, 3 lakh. Then 40 lakh, just a minute. So this is 3 lakh. 40 lakh minus 24 lakh, you will get 16 lakh. On 16 lakh, calculate 30%. So add it for 3 lakh. Whatever we get is called gross tax liability. Hope you understood. Clear? Other calculations, you can easily continue with it. Yes. Fine, guys. So we'll move forward. Yes. Then whatever we discussed now is under the default regime, guys. Please be careful. Next, we will go under the optional scheme. Now, the same set of people, if they don't want to follow the default regime, then they can opt out of default regime and follow the optional scheme, which is called regular provisions of the Act or normal provisions of the Act. What is the tax rates applicable under that? Yes. Up to 2 lakh 50, it is nil. Then 2 lakh 50 to 5 lakh, it is 5%. 5 lakh to 10 lakh, it is 20%. More than 10 lakh, it is 30%, guys. Clear? So up to 2 lakh 50, we call it as basic exemption limit. But if an assessee is a resident individual who is aged 60 or more at any time during the previous year, we call them as senior citizen, and the basic exemption limit would be 3 lakh. So instead of 2 lakh 50, it would be 3 lakh. Rest all remains same. Rest all remains same. And please be careful in the next step also. It is 3 to 5 lakh, not 2 lakh 50 to 5 lakh. Okay, sir. Sir, what if the resident individual is super senior citizen, superman, sir, because his age is 80 years or more? In that case, the basic exemption limit is 5 lakh. There is no first slab at all. 5% slab will not be there. So up to 5 lakh nil, 5 to 10 lakh 20%, above 10 lakh it is 30%. And this benefit is available only to resident individual who is following optional scheme. This benefit is not there under default regime, guys. Irrespective of the age and residential status, the basic exemption limit under the default regime will always be 4 lakh. Please be careful. Yes, sir. Okay. And there is a circular by CBDT telling even if the assessee, that is the resident individual, celebrate his 60th or 80th birthday on the 1st April of assessment year, still they are eligible for higher basic exemption limit, guys. This is a clarification given by CBDT through circular. Yes, sir. So, where are you? Yes. So there are few questions even on this calculation, which is very simple, guys. So I won't be discussing it, but I will just show you. If you want, you can see, guys, whenever I am discussing any question or even provisions, if you feel like, sir, I want to again go through, or I want to go through detail, maybe you will pause the video and please go through it. And if required, if it is a question, you can also practice it once before proceeding further, guys. Yes. So here Mr. A is a resident who is having a income of 16 lakh 50,000. You can observe. So the age is 45, 63, 82. Sir, how can a person play all these three roles in the same year? There's just a possibilities, guys, to solve the questions in the class. Yes, sir. So you can see here the basic registration limit would be 2 lakh 50 because he is following optional scheme. Okay, is opting out of default regime, guys. Yes. So here the basic essential limit would be 2 lakh 50, and here it is 3 lakh because he is senior citizen, and here it is 5 lakh because he is a super senior citizen, guys. Yes, sir. Fine. We'll move forward. Then we are still now what we have covered is slab rate SSC, which covers who and all, guys. Come on, repeat along with me. Who and all is covered in slab rate SSC, whichever we discussed till now. Individual, HO, HUF, AOP, BOI, and artificial juridical person. 5 set of people. Okay. Now what about others? For partnership firm, LLP, and local authority, if they are having any normal income which is taxable at normal rate, the tax rate is 30%. 30%, guys. Then coming to companies, for tax rate purpose, we need to segregate companies into two category: foreign company and domestic company. For foreign company, the tax rate is 35%, whereas for domestic company, they have optional scheme available. So they have one optional scheme available under section 115 BAA. If they opt it, the tax rate is 22%. Or if they want to follow 115 BAB optional scheme, they have to be domestic manufacturing company. Only for domestic manufacturing company who is registered on or after 1st October 2019 and who has started manufacturing on or before 31st March 2024 is eligible for it. The tax rate for such domestic manufacturing company is 15%. But if the domestic company wants to follow any of this optional scheme, then they have to forego various deductions and exemptions, guys, which is almost same like section 115 BAC. Okay. Now, if domestic company has not opted for any of this optional scheme, then we need to check what is their turnover or gross receipts in the year 23-24. In the year 23-24, guys, we are deciding the tax rate applicable for domestic company for the financial year 25-26. But here we are checking the turnover of the year 23-24. If it is up to 400 crore, we consider them as small domestic company, and the tax rate applicable in the current year would be 25%. Whereas if the turnover of a domestic company in the year 23-24 is more than 400 crore, then they will fall here. The tax rate applicable would be 30%. Is that clear? And this is only when the domestic company is not opting for optional scheme. And do we call this as default scheme? No, no, guys. For companies and all, we don't call anything as default scheme. We call this as normal provisions or regular provisions. Is that clear? Yes, sir. Then for cooperative society also, slab rates is applicable up to 10,000 10%, 10,000 to 20,000 20%, more than 20,000 it is 30%. Even cooperative societies also has optional schemes available. What is it? I have given you. Tax rate in case of manufacturing cooperative society resident in India means they have to be engaged in manufacturing. Set up and registered on or after 1st April 2023 and commences manufacture of article or thing before 31st March 2024. Guys, the time period is already over. But if they are satisfied this condition, even today, the tax rate applicable for them would be 15%. 15% of the income which they are earning from manufacturing business, guys. Okay. There is one more optional scheme for the resident cooperative society. Resident cooperative society who is opting for section 115 BAB means who is not engaged in manufacturing. They are doing something else. In that case, the tax rate is 22%. And even if the cooperative society is following the optional scheme given under section 115 BAE or BAD, they have to forego certain exemptions and deductions, guys. But these sections, this as well as for domestic company, whatever we saw, two sections, they are not covered in detail in your syllabus, guys. You need not worry. Whereas section 115 BAD is covered in detail. Okay, sorry, BAC is covered in detail for you. BAD will come for cooperative society. Whereas for individuals and all, there is a default scheme available under section 115 BAC. No, that is very important for you. In detail, it is covered in your syllabus. Okay, so okay. Now, till now, whatever we have discussed is the tax rates applicable on normal income. Now we will discuss special income, guys. As I already mentioned, whoever is earning this income, whichever scheme they are following, the rate remains same, guys. So please be careful with it. Hello, got it? Yes, come on, tell yes. Yes. First, section 11A, which talks about short-term capital gain on the transfer of left. Okay, I have given a shortcut left. What is left, sir? Listed equity shares in a company, units of equity-oriented fund, and units of business trust. So LEFT stands for LE stands for listed equity shares, and F for equity-oriented fund, and T for units of business trust, guys. This is just a short. Please don't use any shortcut which I am giving to remember in your exams, guys. Okay, this is just to recall the provisions. Okay. So if assessee has earned any short-term capital gain on the transfer of LEFT, then the tax rate applicable on that would be 20%. Any other short-term capital gain, if they are earning, it is considered as normal income taxable at normal rate, which we already discussed, guys. Like for example, short-term capital gain on the transfer of land, building, gold, all this are considered as normal income. Only three short-term capital gain is considered to be special as per section 111A. And if the same gain, if it is long-term on the transfer of this assets, then it is covered under section 112A, guys. Long-term capital gain on the transfer of LEFT, that is listed equity shares in a company, units of equity-oriented fund, and units of unit trust. Then it is covered under section 112A. What is the rate? 12.5% on the long-term capital gain exceeding 1,25,000, guys. So up to 1,25,000, it will not be taxable. In excess of 1,25,000, whatever is there, that part only will be taxable. Sir, what if long-term capital gain under section 112 is less than 125? Then nothing is taxable. Nothing is taxable. Sir, what if it is 2 lakh? Then first include entire 2 lakh under the head capital gains while computing total income. Please include full 2 lakh. Then while calculating tax, you reduce 125. Remaining 75,000 would be taxable at 12.5%, guys. Hope you understood. Guys, please be very careful. Don't reduce 1,25,000 while computing your total income. Whatever is the long-term capital gain under section 112A, include it entirely while computing the total income under the capital gains. Only while calculating tax, please reduce 1,25,000. Hope you got it. Yes, sir. And for both of this, the condition is STT has to be paid, guys. That is securities transaction tax has to be paid. Clear? That is for shares, both at the time of purchase as well as sales, the STT has to be paid. Whereas for units of equity oriented fund and unit of business trust at the time of sale. Got it? Yes, sir. And sir, what the long-term capital gain the associate has earned at different point of time during the previous year. For every sale, will he get a benefit of 1,25,000? No, no, no. Throughout the year, the total exemption available is 1,25,000, guys. And please be careful. This is only while calculating tax and not while calculating the income. Got it? Yes, sir. Then, if there is any other long-term capital gain other than the transfer of LEFT, then it is covered under section 112. What is it? This is important, guys. Long-term capital gains on the transfer of other than covered under section 112A means other than LEFT. Okay. Under that, there are two categories. First, land or building or both acquired by resident individual or HUF. When did they acquire it, sir? On or before 23rd July 2024. Clear? So you need to, this is the important date for capital gains hit, but it was important last year, guys. Clear? Actually, capital gains topic undergone a major change on 23rd July 2024. That is in the last financial year. Last financial year, if at all, if you guys have studied, then two things used to study. Before 23rd July, what was there? On or after 23rd July, what was there? Clear? So now only new provision. Sir, should we know the old rate or old provisions? No, guys, you need not worry about it. Clear? Yes, sir. So let me read this point again. If there is any land or building which is acquired by resident individual or HUF before 23rd July 2024, but they have sold it on or after 23rd July 2024, guys. Okay. Then what is the tax rates? They have two options. While calculating the tax liability, they have two options. What is it, sir? Lower of 20% with indexation or 12.5% without indexation. So they have to compute two long-term capital gain. One is with indexation, the other one is without indexation. And calculate tax liability on both and check whichever is lower, they will take that. But this benefit is only while calculating tax liability, guys. Please be very careful. I will discuss one illustration on this once I am done with this section. Next, land or building or both acquired by resident individual or HUF on or after 23rd July 2024. That is after the changes are being made. Will they get this benefit? No, sorry. Or for any other assets acquired anytime. Anytime. Any other assets means what and all is covered here. Other than left and other than land and building. And please be careful, if it is a land or building acquired by any other person also, it can come here only. For example, partnership firm or company and all, it will come here because they also don't get this benefit no matter when they have acquired it. Got it? Yes, because this benefit is available only for resident individual and resident HUF guys. Okay, sir. So what is the tax rate? 12.5% without indexation. So we need to compute long-term capital gain without indexation. On that, the tax rate would be 12.5%, guys. Okay. Then I have also given you, even for them, the rate is 12.5% without indexation, but still I have just mentioned here because previously it was different. In case of a non-resident, long-term capital gain on the transfer of unlisted securities or shares of a closely held company would be taxable at 12.5% without indexation and foreign currency fluctuation. Got it? Because they would have bought and sold in a foreign currency. So there will be an effect of exchange rate fluctuation. So should we consider it? No, guys. Okay. Guys, this is very important with respect to your calculation. They may test it. Last year also it was very important, but now also I feel if they want to keep the question little tough or challenging, then they may test this area. Okay. So I will try to cover one illustration on it. Just a minute. I will take it up. Yes. So in the question bank, page number 41, I have given this illustration on section 112. You can come to that. Yes. Tax payable on long-term capital gain under section 112, guys. Date of purchase 10th October 2015. So which is before 23rd July 2024, guys. Okay. Cost of purchase is 10 lakh, cost of acquisition. Date of transfer is 10th November 2025. That is during our previous year. Sale value, which is our previous year, 25, 26. Correct? Huh? Yes. Normally, whenever they're asking you to compute any capital gains or tax liability on capital gains, the year of transfer would be our previous year, guys. Okay. Sale value, 50 lakh. Okay. Now, we need to compute long-term capital gain without indexation. How much is that, sir? 50 lakh minus 10 lakh, which comes to 40 lakh, assuming there is no expenses on transfer and all this. Got it? Yes. So long-term capital gain without indexation is 40 lakh. Now listen carefully. Hello, please listen carefully. Listen here. This entire 40 lakh has to be included in the total income calculation of an assessee under the head capital gains. Entire 40 lakh. Got it? Yes. So if the question is only on total income calculation, you can just stop it here. You need not do anything else. Sir, but what if they are asked to calculate tax liability? Then we need to do one more calculation. What is it, sir? So on this long-term capital gain without indexation, apply 12.5% tax rate and compute tax liability, 5 lakh. I've given a notation A, keep it aside. One calculation is done. Now coming to, we need to compute one more long-term capital gain, but with indexation. With indexation. Because, sir, is this condition satisfied here? Yes, guys. It will fall under this. Okay. Okay, fine. So 50 lakh is the full value of sale consideration. From that, I am reducing index cost of acquisition. So how do we calculate index cost of acquisition? Take cost of acquisition into cost inflation index for the year of transfer. Cost inflation index for the previous year 25-26 is 376, which we will learn in capital gains head, guys. Okay, divided by cost inflation index for the year of purchase, that is 15-16. I have taken here 254. If at all, if it is required, it will be given in the question. You need not worry. Okay, fine, sir. So how much we are getting? 35 lakh 19,685, which is a long-term capital gain with indexation. On this, what is the tax rate, people? 20%. So what is the tax liability? 7 lakh 3,937, which I am naming it as B. So should assessee pay both? No. Whichever is lower. Whichever is lower. So in its tax calculation, we should include how much people? 5 lakh. And other calculation remains same. Assume now assessee has other incomes also. On that and all, calculation would remain same. Calculate the tax, just add 5 lakh for this, then add up and calculate gross tax, then continue with the same calculations. Other things will remain same, guys. Is that clear? So please be careful, guys. This part will come only if the question is asking you to calculate tax liability. If the question is asking you to calculate only the capital gains income or total income, you can just calculate 40 lakh, include it under the head capital gains and leave it there. That's all. So hope you understood. So this benefit is not there while computing total income. This benefit is only while computing tax liability. Is that clear? And this concept again I will explain when I am teaching you capital gains head, guys. Is that clear? So I have tried to take an illustration and explain you, because if I just explain like that, everyone might not be able to get it, guys. Got it? Yes. So if you want, you can just pause the video and have a look into this, check the calculations, and then proceed further, guys. Okay, sir. Then we have some more special income. We will see that. Yes, this incomes are taxable. Whatever we will learn now, no, 115 BB, BBJ, and BBE, these incomes are taxable under the head other sources, guys. Sir, what about the above? It will be taxable under the head capital gains. Guys, see, long-term capital gain on the transfer of any asset will always be long-term. Sorry, will always be special income. Will always be special income. Yes, sir. Whereas short-term capital gain on the transfer of LEFT will only be special. Whereas any other asset, it will be considered as normal income, guys. Okay. Full Josh. I should bring Josh in you, no? So that is why I am showing Josh. Yes. Section 115 BB. Winnings from lotteries, crossword puzzles, races, including horse race, card games, and other games of any sort, gambling or betting of any form of nature. We call it as casual income, but other than online gaming. Okay, so what is the tax rate? 30%. Sir, what if the associate has winnings from online games? Then it is covered under section 115 BBJ. But the provisions rate, everything is same, guys. So what is the rate? So 30%. Then section 115 BBE, which I already covered in the first chapter, guys. Undisclosed income, that is unexplained money, investment, expenditure, etc., deemed as income under section 68 or 69 or 69A or section 69B, C, D. Yes, these are taxable at what rate? 60%. But actually, rate is 60% plus surcharge is always 25% plus 4% health and education cess. It comes to how much? 78%. Please don't get confused. Surcharge will always be levied on the rate, that is the gross tax, not on the income. Okay, so it will be 60. On 60, it would be 25%. Then whatever you get on that, 4%. So the effectively the rate comes to 78%. Clear? So if you have any undisclosed income of, assume 100 rupees, out of that 78 rupees, you will pay it as income tax. Okay, sir. Then, then against this, we cannot set off basic essential limit. We cannot claim any chapter 6A deduction. We cannot even adjust basic exemption limit, and we cannot claim any expenses or deductions, guys. Actually, I've given a note here. Whatever special income the assessee has, no, against that, no deductions under chapter 6A can be claimed, guys. No deductions, nothing contained in section ATC to ATO can be claimed against the special incomes. Is that clear? Whereas against casual income and undisclosed income, you cannot even adjust basic exemption limit. You cannot even adjust basic exemption limit. For example, sir, I have only 5 lakh casual income, straight away taxed at 30%. Sir, I am an individual, sir, following default regime, sir, will I get a benefit of 4 lakhs, sir? So, no, sorry, you cannot get it. Okay, same way, sir, I have an undisclosed income of 10 lakh. I am a resident individual who is following default regime. How much tax should I pay? 10 lakh into 78%. Or else 10 lakh into 60%, you will get 6 lakh plus 25% surcharge plus 4% health and education cess, guys, which comes to 7,80,000. Is that clear? Yes, sir. Fine, guys. Now, the most important thing, rebate, which has undergone an amendment, guys. Yes, let us learn it. Rebate from income tax to resident individual, section 87A. Guys, rebate under section 87A is a benefit given to the assessee, but it is available only to resident individual. Yes, sir. Rebate under section 87A is available only to resident individual whose total income is within certain limit. So it will change as per the scheme opted by the resident individual first under the default regime. Amendment. Come on, pay attention. Yes. If the total income of a resident individual is up to 12 lakh, that is 12 lakh or less, then they are eligible for a rebate of how much? Actual tax liability or 60,000, whichever is lower, means maximum 60,000. Maximum 60,000. And if you are a resident individual who is earning income up to 12 lakh, then you need not pay any tax under the default regime, guys. Is that clear? Yes. So I have one question on it. Quickly we'll go through. As it is an amendment part, I want you guys to be very careful. I somewhere feel that this will be tested in the exam, guys. Yes, I cannot assure you, but somewhere that inner feeling within me, inside me, is telling questions can be asked on rebate. Yes, sure. Mr. Raghav, aged 26 years and a resident in India, has a total income of 11 lakh 50,000, comprising his salary income and interest on bank FD. Compute his tax liability under the default tax regime under section 115 BAC. Okay. Fine. So up to 4 lakh, nil, 4 to 8 lakh, 5%, which comes to 20,000, 8 lakh to 12 lakh it is, but we need to stop it at 1150 because the total income of any resident individual is only 11 lakh 50, guys. So 10%, 1150 minus 8 lakh, you will get 3 lakh 50 into 10%, you will get 35,000. So what is the gross tax? 55. So what is the rebate available? 55,000 or maximum 60,000, whichever is lower, 55,000. So what is the tax liability, guys? Nil. You need not pay any tax. And please be careful, rebate should always be claimed before health and education cess. Before health and education cess. Yes, sir. Okay. Anyway, if by chance, if this figure is positive, then we will add 4% health and education cess for it and pay to the government. Okay. And I have given a note also, whenever there is any rebate available, guys, please give a note for it in your answer. Because the evaluator will expect it. Okay. Even I expect you to write. Okay. Sir, what if the total income is more than 12 lakh? Guys, if the total income of a resident individual who is following the default regime is marginally more than 12 lakh, still they are eligible for rebate. But in such case, we need to calculate rebate by following the following steps. What are those? First, step 1. Total income minus 12 lakhs. Okay. 12 lakh is like a limit here. Then compute the income tax liability on entire total income, whatever is your total income. Okay. Then if B is more than A, assessee is eligible for a rebate. Sir, what if by chance if A is more, then no rebate? No rebate. Okay. So I will just give an example. Assume the total income of a resident individual who is following default regime is 12 lakh 30,000. 12 lakh 30,000. Now if his income was exactly 12 lakh, his tax liability would have been 0. Correct. Now it is 12 lakh 30. So just for 30,000 increase in income over and about 12 lakh, his tax liability will be more. Assume it is like 70,000. So is it fair? Just for 30,000 increase in income, tax liability is increasing from 0 to 70,000. So they thought, okay, this is not fair. Somewhere similar to our marginal relief concept. So they are giving the difference, that is 70,000 minus 30,000, 40,000 as rebate, not relief, rebate. Relief, marginal relief is a separate concept, guys. But this, whatever we are doing here, no, this is similar to that. Similar to that. Got it? Yes. And you please apply these steps only when total income of a resident individual who is following default regime is more than 12 lakh, but up to 12 lakh 70,585. Try to remember this figure, or at least 12 lakh 70,000. Okay. So only if the total income is within this amounts, please apply these steps. Sir, what if it is more than 12 lakh 70, for example, 13 lakh, 14 lakh, 15 lakh, then no need to apply this, guys. Even if you apply and check nothing wrong, you will not get rebate, that's all. Why so? Because in that case, A will be more than B, guys. When A is more than B, no rebate. Is that clear? Yes. And this is a number which is computed, and you need not worry. This is not given in the law. Okay. You just try to remember, only when the total income of a resident individual who is following default regime is in between this, apply these steps, guys. Clear? Yes, sir. I have one question on this. Let me just do it. Yes. Pawan is a resident aged 35 years, having a total income of 12 lakh 20,000, which includes only normal income, and is following default regime. So what should we do? Can we check the rebate by applying the following steps? Yes, guys, because it is more than 12 lakh, within 12 lakh 70,000. Got it? Yes, sir. Yes. So total income in excess of 12 lakh is how much? 1220 minus 12 lakh, 20,000. Keep it aside. Then calculate the tax on entire total income of 12 lakh 20,000. Okay, I need not explain the calculation again. So straight away I will go to the figure 63,000. Just for 20,000 increase in income beyond 12 lakh, tax liability is going up by how much? 63,000. Because if his total income is exactly 12 lakh, what is the tax liability? Zero. Zero. Correct? Huh? Yes, sir. Sure. So, how much is the rebate available? The difference between 63,000 and 20,000, guys, which comes to 43,000. 43,000 rebate is available. Okay. So, remaining 20,000 plus 4% health and education cess has to be paid by Pawan, which comes to 20,800. Got it? Yes, sir. Okay, done with the rebate under the default regime, guys. There's an amendment part. Please be very careful. If you want, you please pause the video and go through it once again. Yes. Now coming to rebate to a resident individual who is opting out of default and following what? Optional scheme. For them, if the total income is up to 5 lakh, they are eligible for a rebate of actual tax liability or 12,000, whichever is lower, guys. And this part is not there for them. Clear? If their total income is assume 5 lakh 1 rupee, they have to pay tax from 2 lakh 50. They have to pay tax from where? 2 lakh 50. Is that clear? Yes. Rebate is available only if the total income is less than or equal to 5 lakh, guys. If it is marginally more than 5 lakh also, no rebate is available. Unfair for the assessee who is following optional scheme, guys. Yes, sir. So one quick question on that also. So Piyush is a resident individual who is aged 35 years, having total income of 4 lakh 60,000 and is shifting out of default regime. That means he's following optional scheme. Yes. So up to 2 lakh 50, nil. Then 2 lakh 50 to 5 lakh, it is 5%, but we have to stop it at total income, 460 here. Okay, sir. So 460 minus 250 into 5%, 10,500. So is eligible for a rebate. I have given a note here. You can see, yes. How much rebates are? Actual tax liability or 12,500, whichever is lower, which comes to nil, guys. And when this figure is nil, no question of health and education says, guys. Okay. There are few notes on rebate. First one, the amount of rebate under section 87A shall not exceed the amount of income tax, that is nothing but gross tax liability on the total income of the associate. Correct? So they are told here also maximum 60,000, whereas here maximum 12,500. Clear? And it is not flat. It is maximum. Actual tax liability or the limit, whichever is lower, guys. Okay. Then rebate should always be calculated before health and education says. Please be careful because sometimes students in a hurry, first they will add health and education says, then they will provide rebate. Please don't do that mistake, guys. C is a very important point. It is an amended point. Please be attentive, guys. Look here. Hello. Please pay attention. I will call your parents now. In between, no notification. Don't entertain any notifications. Come on. Only notify me. In case the assessor is paying tax under the default tax regime, rebate under section 87A is not available in respect of tax payable on any special income. Hello, any special income. Under the default regime, any tax which is supposed to be paid by the assessor on special income on against it, no rebate. Whether it is long-term capital gain, short-term capital gain under section 111A or casual income. If assessee have any of this special income, whatever tax he is supposed to pay on that, he cannot claim it as a rebate. Okay. Whereas if the assessee is opting out of default scheme, that means he is following optional scheme. Rebate under section 87A is not available in respect of tax payable on long-term capital gain under section 112A only. Please be careful. There is a difference between both these guys. I repeat. I will also explain this with an illustration. Don't worry. But pay attention here. If a resident individual's total income is within 12 lakh, but it includes any special income, whatever tax is supposed to pay on special income, he cannot claim any rebate under default regime against it, guys. Whereas whatever tax is supposed to pay on normal income, can he claim rebate? Yes, he can claim. Whereas if a resident individual is following optional scheme, rebate is not available only against 112A tax. That means if I am a resident individual whose total income is less than 5 lakh, but my total income has casual income or it has short-term capital gain under section 111A, can I claim rebate against it? Yes, you can claim. Yes, you can claim. Yes, guys. Come on. I have an illustration on this. Very important, guys. Even this is a part of rebate. I told you I am expecting a question on this in the exam, no? So that might also cover this area. Please pay attention. So this is there in page number 42. Illustration on rebate under section 87A under the default scheme, section 115 BAC. Okay, sir. So assessee, long-term capital gain under section 112A, he has 2 lakh. Then casual income under section 115 BB, 1 lakh. And other income, which is taxable at normal rate, 7 lakh. So total income is 10 lakh. It is less than 12 lakh. Is he eligible for rebate? Yes, he is eligible for a rebate. But how much rebate can he claim? Tax on long-term capital gain under section 112A, 2 lakh he has, but up to 1,25,000 it is not taxable. Guys, please be careful. Can you observe in total income calculation I have taken full 2 lakh, but while calculating tax I am reducing 125. You are also supposed to do this way. Okay. Remaining 75,000 is taxable at 12.5%, which gives us 9,375. Then tax on casual income, 1 lakh into 30%, which comes to 30,000. Okay, sir. Then tax on other income, 7 lakh is other income. So basic exemption limit under the default regime is 4 lakh. BEL stands for basic exemption limit. Remaining 3 lakh is taxable at 5%, guys. So that will give us 15,000. 15,000. So what is the gross tax liability? 54,375. Can he claim full amount as rebate? No, sorry. No rebate is available against the tax payable on special incomes, guys. Yes. So what is the maximum rebate available? 15,000. That is the tax on normal income. Remaining 39,375 has to be paid plus 4% cess. Plus 4% cess. So the total tax liability comes to 40,950. And if at all, if there is any TDS credit and all, we will reduce from this. Clear? Because on casual income and all, TDS would have been deducted. If it is given, then please give a credit for it. Reduce TDS from this figure, guys. Is that clear? Yes, sir. Fine. This is for the assessee who is following default scheme. Sir, what about the assessee who is following optional scheme, whose age is less than 60 years? Let us see how much income he has. Long-term capital gain under section 112A, 1,50,000. Casual income under section 115BB, 20,000. And other income, which is taxable at normal rate, 320. So the total income is 490 within 5 lakh. Is he eligible for rebate? Yes. Okay. Coming to the tax calculation. Tax on long-term capital gain under section 112A, 150 is the actual figure which we have considered here, but up to 1,25,000 it is not taxable. Remaining 25,000 is taxable at 12.5%, guys. So we will get a figure 3,125. Tax on casual income, 20,000 into 30%, which will give us 6,000. Then tax on other income, 320 minus 250. Basic exemption limit under optional scheme is 2,50,000. Please be careful. And age is less than 60. I have clearly given. Okay. Sir, what if his age is more than 60? Or more than 80, then accordingly this figure will change to 3 lakh or 5 lakh, guys. Okay. Okay. If it is 5 lakh and all, there is no tax here. Okay, fine. Let us stick to our case, whatever is there. 3,500. So gross tax liability will be 12,625, guys. Now, what is the rebate? Can he claim full amount as rebate? No. There is no rebate available against 3,125, guys. Remaining, can he claim? Yes. How much is that? 9,500. 9,500 rebate is available. Remaining, which is nothing but tax under section 112A, he has to pay plus 4% health and education cess. So the total tax liability comes to 3,250. And even here, if there is any TDS credit available, please deduct it. Remaining will be the tax payable. The remaining would be the tax payable, guys. So here my intention, the main focus was on rebate is available against what? Guys, under default regime, I am repeating it again and again. I know, I am aware of it, but I want you guys to understand as it is exactly. Please pay attention. One last time. Please pay attention here. Rebate is not available against the tax on special income for the resident individual who is following the default scheme under section 115 BAC. Let it be tax on any special income, guys. Whatever we have discussed, no rebate. Only rebate is available under section 87A on tax payable on special income for the assessee who is following default scheme. Whereas for the assessee who is following optional scheme, rebate is not available only against 112A tax. On any other special income along with normal income, whatever is the tax payable, rebate is available, guys, provided other conditions are satisfied. Okay, guys. So this is all about the rebate part. Okay. Now let us discuss surcharge. There is no amendment in surcharge, but important topic because most of the students get confused here, guys. Yes. Surcharge is an additional tax payable over and above the income tax. Surcharge is levied as a percentage of what? Income tax. Guys, one important thing you have to take care. Whenever you are supposed to calculate the tax liability, after gross tax liability, just pause for a second and see whether surcharge is applicable or not. Sir, when is surcharge applicable? You need to see whether the total income is more than the specified limits like 50 lakh, 1 crore, 2 crore, 5 crore and 10 crore tax. Only when the total income of an assessee is more than certain limits, surcharge would be applicable. But when surcharge is applicable, we need to apply the rate of surcharge not on the total income, but on the gross tax liability. Clear? I repeat. For checking the applicability of surcharge, we need to see total income figure. If total income is more than specified limits like 50 lakh, 1 crore, 2 crore, 5 crore, 10 crore, then surcharge is applicable. When surcharge is applicable, assume 15%. 15% has to be applied on total income or gross tax liability now. Gross tax liability. Is that clear? So please be careful. Actually, it leads to tax on tax. The cascading effect, which you would have learned in GST or indirect tax. But anyway, government is charging it and it is a part of income tax, guys. Okay, fine. For the first set of associates for whom I call them as slab rate associate, that is individual HUF, AOP, BOI and artificial juridical person, that is AJP, not BJP, AJP. Yes, who is following default scheme. Okay, surcharge rate is different under both the schemes, guys. Yes. So first we will see when the total income of a associate who is covered here, no, any of them, if it is up to 50 lakh, no surcharge, guys. No surcharge. Okay, sir. If it is more than 50 lakh up to 1 crore, it is 10%. 10% of what? The gross tax. Rate of surcharge on income tax means here it is nothing but gross tax. Okay. More than 1 crore but up to 2 crore, it is 15%. More than 2 crore, it is 25%. But while calculating more than 2 crore, we need to exclude capital gain, special income and dividend income. Guys, dividend income is actually not a special income for tax rates purpose, but only for surcharge purpose. They're treating it as special. Okay, all these are like investment related incomes, guys. Okay, if you have invested in shares, you will earn dividend income when you are holding it. That is during your holding period. That is covered here. And what if I sell it, sir? Then you will earn capital gains income. Not only on shares, all the capital gains income which are special in nature are covered here. 111A, 112 and 112A, guys. So on this income, no, on this income, whatever income tax is calculated, on that the maximum surcharge rate is 15%, guys. I have given here. The maximum surcharge rate on tax calculated on capital gain, special income and dividend income would be 15%. Okay, coming back to this. Oh. So if total income is more than 2 crore, excluding the capital gain, special income and dividend income, on that whatever tax we calculate, surcharge rate would be 25%. And on whatever tax we calculate as per section 111A or 112 or 112A, that is on capital gain, special income as well as dividend income, the surcharge rate would be 15%. Got it? Yes. Sir, what if our total income is more than 2 crore, but only if I include capital gain, special income and dividend income? In such case, whatever gross tax you will calculate, that is first calculate tax on special income plus tax on normal income, you will get gross tax. On gross tax, the surcharge rate would be 15%, guys. Got it? Yes. I have illustrations on this in my provision book. I will just go through it, guys. So just observe one by one, I will explain. So in the first case, the total income, that is the first illustration, the total income of an assessee is 95 lakh, which includes short-term capital gain under section 111A, 30 lakh, and long-term capital gain under section 112A, 25 lakh, and other income, 40 lakh. So as the total income of an assessee is more than 50 lakh, what should we do? First, calculate tax on special income, then tax on normal income at normal rates. Add up both, you will get gross tax. On gross tax, 10% would be the surcharge, guys. Got it? Yes. So this is an illustration applicable for first case. Okay. Next, second case. Total income is 1.75 crore. That is more than 1 crore, but up to 2 crore, which includes 2 special income and 1 normal income. Okay, sir. So again, same way. First, calculate tax on special income. For that, you add tax on normal income. You will get gross tax. On gross tax, add 15% surcharge. Got it? So this is an example or illustration for this second case. Next, we will see this. Yes. Assessee has a total income of 4.09 crore, which is more than 2 crore, but it has two special items. Special items for surcharge purpose. Please be careful. Dividend is special for surcharge. Okay. So if I exclude this, what is the other income other than the capital gain special income and dividend income? 3 crore. Is it more than 2 crore people? Yes. So that means whatever tax you calculate on this, the surcharge is 25%. Whereas whatever tax we calculate on dividend income and long-term capital gain under section 112A, whatever tax we get on that surcharge rate would be 15%. So two separate rates, guys. This is an illustration as per this point. Got it? Yes, sir. Next. Yeah. Fourth illustration. The total income of an assessee is 2.25 crore, which includes even capital gain special income. So if I exclude capital gain special income, the income is coming to 1.10 crore. That means less than 2 crore. So only if I include all the capital gain special income, it will be more than 2 crore, guys. So there is only one surcharge rate applicable. Compute tax on special income plus tax on normal income, you will derive gross tax. On that surcharge rate would be 15%, guys. This is as per this point. Yeah, please be careful. This is different. This is different. Here, the total income is more than 2 crore, excluding the capital gain special income and dividend income. So there are two separate rates. Whereas here, total income is more than 2 crore, but only if you include all the capital gains income or the dividend income. If you exclude them, then it is less than 2 crore. Clear? In that case, only single rate would be applicable, guys. Is that clear? Yes. Actually, in my regular class, I have solved each one of this illustration under both the schemes, that is optional as well as default. But now I will not be able to do it, guys, because this require almost one class to do it. So due to time constraint and as it is a revision class, I will not be able to do it in detail. But anyway, hope you guys will be able to understand with these numbers. Okay, sir. Now let us move to optional scheme. Individual HU of AOP, BOI and artificial juridical person exercising the option shifting out of default scheme. That means they are following which scheme, people? Optional scheme. Yes, sir. If they have total income up to 50 lakh, no rebate. More than 50 lakh up to 1 crore, 10%. More than 1 crore up to 2 crore, 15%. Sir, same to same. Yes, once change is there, we will see. More than 2 crore up to 5 crore, excluding capital gain special income and dividend income, it is 25%. Whereas whatever tax you calculate on capital gains income and dividend income on that surcharge rate is 15%. And here it is taken as up to 5 crore. Now, what if total income excluding the special item is more than 5 crore? Then the surcharge rate is 37% on it. Whereas on capital gains special income and dividend income, whatever tax you calculate on that 15%. Guys, this is one additional point under optional scheme. There is a rate of 37%, the highest rate of surcharge under optional scheme, whereas the highest rate under default regime is only 25%. Is that clear? So please be careful. This part, this and this is additional under optional scheme. Sir, what if the total income is more than 2 crore, but only if I include capital gain special income and the dividend income, then on the entire gross tax, the surcharge rate would be 15%, guys. Is that clear? So please be very careful. It is almost same except this part. Yeah, if it is more than 2 crore, straight away here it is 25%. More than 2 crore, more than 5 crore, more than 10 crore, everything rate is same, 25%. Yeah, whereas here it is two different things are there, 25 and 37, guys. Is that clear? Yes, I have given one illustration for both of them also. Same, but under two different scheme it will change. What is it? We will see. Fifth one, guys. Fifth one. The total income of an associate is 7.15 crore. And if we remove the special items, we are getting 6 crore. we are getting 6 crore. And assume the assessee is following the default scheme under section 115 BAC. That means this is more than 2 crore, excluding special items. Yes. So two separate rates are applicable. First, calculate tax on special income. On that, surcharge rate is 15%. Okay, sir. Then calculate tax on the remaining income. On that, surcharge rate would be 25%. Got it? Same scenario. What if assessee is following optional scheme? Same to same numbers. Okay. Obviously, guys, total income will not remain same under both the schemes because there are few exemptions and deductions which are blocked under the default scheme. But anyway, here I have taken it so that you will understand the difference between both, guys. So assume same scenario, but assessee is following optional scheme. So what is the total income? 7.15 crore. So if we exclude the special items, then we are getting 6 crore. It is more than 5 crore. More than 5 crore. Okay, sir. So first calculate tax on special income. On that, surcharge rate is 15%. Then calculate tax on the remaining income. On that, surcharge rate is 37%, guys. 37%. So this is the difference. Please be careful. Got it? Yes. If you want, you can just pause for a moment. I will just show all the illustration. You can just pause for a second. Look at the rates. Then check the illustrations, how it is applied. Yes. Okay. For slab rate assessee, we are done. Next, for other set of people, we will see. For partnership firm, LLP and local authority, if the total income is more than 1 crore, surcharge rate is 12%, guys. More than 1 crore, more than 10 crore, more than 15 crore, whatever is the number, surcharge rate is 12%. Whereas for companies, for foreign company, already the tax rate is more, 35%. So that is why surcharge is kept lower, guys. If the total income is more than 1 crore up to 10 crore, it is 2%. If it is more than 10 crore, 5%. Guys, if it is more than 10, straight away apply 5%. Don't apply anything like slab and all. Clear? For example, total income of a foreign company, assume is 6 crore. Surcharge is 2%. What if the total income is 12 crore? Straight away 5%. Straight away 5%. Okay? Yes. Then for domestic company and cooperative society, if the total income is more than 1 crore up to 10 crore, it is 7%. And if it is more than 10 crore, it is 12%. For domestic company, the tax rates are lower, right? Yes. So that is why the surcharge rate is higher for them. And easy to remember for company, guys. 2 plus 5 will give us 7. 7 plus 5 again will give us 12. So easy to remember like that. Yeah. Whereas, if a domestic company is following the optional scheme given under section 115 BAA or BAB, or if it is a resident cooperative society who is following the optional scheme given for them under section 115 BAD or BAE, for them always surcharge is fixed at 10%, irrespective of the income, whether they have 1 rupee income, 1 lakh income, 1 crore income, 10 crore income, doesn't matter. Surcharge is 10%, which is fixed. Which is fixed, guys. Got it? Yes, sir. Fine. Next, guys, for AOP, association of person, we already covered here. Who can be a member of AOP? Any person, including companies. But only if companies are a members of AOP, then the surcharge rate is different for them. Whether they are following default regime or optional scheme, doesn't matter. Only if companies are a members of AOP, then the surcharge is as follows. Up to 50 lakh, no rebate. Sorry, no surcharge. More than 50 lakh up to 1 crore, 10%. More than 1 crore, 15%. Is that clear? Or, sir, what if AOP is having any individual or partnership firm as a member? Then we need to follow this, whatever is given here. Okay, the first two rates they have taken there. That's all. Whereas 25%, 37% and all is not applicable for them. And here there is no need to segregate also. Special items, normal items and all, nothing to segregate, guys. Okay, sir. Next. Health and education cess will always be there at 4%, guys. Will always be there at 4%. Please don't miss it. Okay. Then total income should always be rounded up to nearest to 10 rupees as per section 288A. That is 5 or more. If the last digit is 5 or more, take next 10. Less than 5 means take previous 10. Same way, the final tax payable, or if it is a refund, means if excess TDS is deducted or TCS is collected or advance tax is paid, assessee will be eligible for a refund, right? Yes. So if final tax payable or refund due has to be rounded off to nearest to 10 rupees as per section 288B. Same rule, guys. 5 or more next to 10, less than 5, previous 10. Is that clear? And computation of total income we are not learning now. Computation of a total income will start only from next chapter, guys. We'll be discussing it. Okay, so we have different heads of income, clubbing, set off and carry forward of losses, deduction, TDS, TCS, advance tax, everything we have to cover. And then we need to see how do we compute the total income, which is all a part of this chapter, guys. Is that, yeah, in this chapter, our focus is only to check, sir, how do we compute the tax liability? And one more important thing, guys. See, as per my material, I have made tax rates as a separate chapter. Whereas if you check ICA material and all, the tax rates and all is covered in the first chapter itself. Yeah, but anything connected to tax rates, including surcharge, rebate, or aggregation of agriculture income along with the non-agriculture income as well as marginal relief, I have covered it in one single chapter. So that anything related to tax rates, you guys can finish it in one single chapter. And what I would suggest is, guys, even on the exam day, please keep this chapter on the morning of exam day. Okay, that is, assume today is the taxation exam. Today morning, before going to the exam, try to study this chapter because a lot of things are there to remember this. So if you want me to tell, sir, which are the topics which I have to keep it on the exam day morning, the topics like tax rates or even TDS deductions and all, try to keep them, guys, because here there are few rates or few amounts or few limits which you have to keep in mind. So it would be better you guys study it fresh before hitting the examination hall. Yes, sir. And if you're liking the session or if you're liking the classes, why don't you hit like button, guys, and give a hype because that will help the video to reach more and more students, guys. Yes. So next, partial integration of agriculture income with non-agriculture income. If you remember, while I was discussing first chapter, agriculture income, and if Asati is engaged in both growing of crops along with manufacturing the product, how do we segregate it as per the specific rules? Yes, sir. But specific rules or even general? Yes. There is a specific rule for coffee, tea, and rubber, whereas for any other general rule. Yes. There I had told if the same assessee has both agriculture income as well as non-agriculture income, then the tax computation is bit different. The rates and all will remain same, but only the computation format will change, guys. How is it we are seeing now? Okay. First of all, when is it applicable? Should I check this always? No, no. Only for slab rate assessment. I have given it here. Note. The concept applies only to individual HUF, AOP, BOI, and artificial juridical person who simultaneously have agriculture income more than 5,000 and non-agriculture income, or we also call it as business income or total income. Okay. Yes. However, they have given it. Please take it in the same way. Is more than basic exemption limit as per the respective scheme followed by the assessee, guys. Okay, sir. See, also, we have learned that agriculture income is only exempt from a land which is situated in India and used for agriculture purpose as per section 10 clause 1. But if a same assessee has both, the department is trying to tax the non-agriculture income at a higher rate, guys. That is the strategy of this partial integration. So the object of aggregating the net agriculture income with non-agriculture income is to tax the non-agriculture income at a higher rate. That is the strategy of the government. How is it also? I will explain with some question, guys. First, let us discuss the format. Please stick to this format. And question might not specify that you have to apply the following steps. Whenever the assessee has both agriculture income as well as non-agriculture income, and if the assessee is the slab rate assessee, please check the integration part, guys. Clear? They may give the figure directly or else we will discuss the rules. No, as per that rule, they will tell Vikas is engaged in growing of coffee and manufacturing coffee. So, what is this tax liability? They will give some figure. First, check how much is agriculture income, how much is non-agriculture income by applying the respective rules. I will just show you once. Hope you remember. Hope you remember. Just now we have discussed in chapter one. Correct? Hello. This part. Correct. So they may try to include both these topics in one single question, guys. Where first you need to identify how much is agriculture income and how much is business income or non-agriculture income, and then calculate tax on that. Yes. Now let me come back. Yes. What do we do, sir? And please be careful, guys. In this case, the tax rates will not change. Tax rates will remain same. There is no change in tax rates. Only the way we calculate the steps is bit different. That's all. Okay. What is that, sir? First, take agriculture income, which is completely exempt as per section 10.1, but still take it in this calculation. Then non-agriculture income, which I can also call it as total income. And please be careful. Total income of an assessee will not include agriculture income because total income will not include any exempt income, guys. Is that clear? Yes. Total of A plus B. Don't call this as total income. It will be wrong. Okay. Actually, total income is this figure. Yes. So we will get both, add up both, and this non-agriculture income can be any income. Sir, can it be a salary income also? Can it be a business income also? Can it be a house property income also? Yes, it can be any income, but other than agriculture. Yes. Sure. Fine. Total of A and B, that is agree plus non-agree. Then tax on C at applicable rate, that is as applicable to the assessee. Clear? Depending upon the scheme followed by them, whichever we already learned. Okay. So till here, one part is done. Keep it aside. Second part. A, that is nothing but agriculture income plus basic exemption limit as applicable. Sir, what is basic exemption limit? It can be 4 lakh, it can be 2 lakh 50 or 3 lakh or 5 lakh, depending upon which scheme they are following, guys. Is that clear? But please be careful. 3 lakh and 5 lakh is available only for resident individual who is following the optional scheme, who is senior or super senior citizen, guys. Okay, sir. Then calculate tax on E as per the rate applicable to the assessee. Okay, sir. Then deduct each other. Whatever tax we have got here, no, from that you deduct this one. So simple. Tax on agree plus non-agree. From that you deduct tax on agree plus basic exemption limit. Got it? You'll get net tax liability from here on. Normal calculation will continue, guys. If the non-agricultural income, which we also call it as total income, is within 5 lakh or within 12 lakh, assessee is eligible for a rebate, provided he is a resident individual. Okay. Then surcharge can be applicable if the non-agriculture income, please be careful, don't check for this figure. This is not total income. This is called total income. Please be careful. Yes. So if non-agriculture income is more than 50 lakh, 1 crore, 2 crore and all, then we need to add surcharge here. Then health surcharge on what figure? This figure. Please be careful. This figure. Okay. Yes. Then health and education says 4%. We need to take it. Then the total tax liability. And if at all, if it is not in 10 rupees or rounded off in 10 rupees, you need to do it as per section 288B, which we already discussed. Okay, sir. Fine. Let me just try to explain this with a question, guys, so that you will get 100% clarity. Just a minute. Hold on. Yes. You can come to question number 7. The total non-agricultural income of Mr. D, aged 40 years, is 15 lakh. The agricultural income earned is 75,000. The expenses incurred for earning agriculture income is 5,000. Okay. Compute the tax liability. First of all, who is the assessee? Individual. What is his non-agriculture income? 15 lakh. Agricultural income 75 minus 5, 70,000. More than 5,000. So non-agriculture income is more than basic exemption limit and agriculture income is more than 5,000. Should we apply this concept, guys? Yes, we need to apply the partial integration. Okay, so let us apply. First, take agricultural income, which is 75,000 minus expenses 70,000. Non-agricultural income, we will get 15 lakh. Then total of both 1570. Calculate tax on 1570 under default scheme. Which scheme they are following? Default scheme. Oh, under default scheme. So the tax liability comes to 1,15,500, guys. Take it to the main calculation. Don't add cess and all here only. We will take care of cess later. Okay. First step done. Second step. A, that is A means agriculture income. Okay. Agriculture income plus basic exemption limit. So 70,000 plus 4 lakh is the basic exemption limit under default regime, guys. So you will get 470. 470. So calculate tax on that. Up to 4 lakh nil, 4 to 470, it is 5%. We will get 3,500. 3,500. Now deduct 3,500 from 1,15,500. You will get 1,12,000. No rebate because the non-agriculture income is more than 12 lakh. No surcharge because non-agriculture income is not more than 50 lakh. So straight away add health and education cess. So total tax liability we get as 1,16,480. Sir, why so much drama, sir? We would have done just normal calculation. We would have calculated tax only on non-agriculture income. No, sir. No, guys. So what is the government trying to do through this partial integration? You can observe here. Cross checking. I've just given for your better understanding. This and all you need not present it in the exam, guys. This only for your understanding. Now assume we didn't do all this partial integration. We are just calculating tax on non-agriculture income as usual. Then how much will be the tax liability? How much will be the tax liability? If you are considering only 15 lakh income, it comes to 1 lakh 5,000 plus 4% health and education cess. Plus 4% health and education cess. Whereas here you can see before cess, how much is the tax? 1 lakh 12,000. 1 lakh 12,000. But if it was a regular calculation, it would have been 1 lakh 5,000. So is there an increase in tax liability? Yes. How did the government do it? Through partial integration. Because in this step, 70,000 will get taxed at what rate, guys? 70,000 will come here. No, it will get taxed at 15%. Clear? Where when we are calculating here on 470, this will get taxed only at 5%. The difference, whatever is coming here, no, here it was taxed at 15%, whereas here it will come at 5%. So they're trying to indirectly collect it from the assessee through tax, guys. Clear? So that is what I have given you. You can see here. The object of aggregating the net agriculture income with non-agriculture income is to tax non-agriculture income at a higher rates. Clear? So they will try to push you for a higher slab, guys. Clear? But obviously, many of the people may not be able to understand this concept. Anyway, the government is trying to collect tax in one or the other way because there are some rich farmers in few states like Haryana, Punjab, and all who has agriculture income crores together along with non-agriculture income. So they're trying to bring them under the tax bracket, guys. Yeah, if you have only agriculture income, I enjoy full 100% exemption. I'm planning for it in future, not now. Okay. Yes. So don't worry, not immediately, in the future, because I know you will be worried about, sir, what about the remaining chapters? Anta? I will complete the syllabus. Don't worry. Marginal relief. It is applicable in case of all the assessee whenever surcharge is applicable. We already learned that when surcharge is applicable. And whenever surcharge has crossed the threshold limit, marginally, that is by a small amount, we need to check marginal relief, guys. We need to check marginal relief. Sir, marginal means what amount and all? You need not remember it. Whenever you have a doubt that whether relief is available or not, just apply the following steps and calculate. If relief is available, you will get it. If not, you will get it as zero. Is that clear? I will explain that concept. Don't worry. Yeah. So whenever the total income is marginally more than like 50 lakh, 1 crore, 2 crore, 5 crore or 10 crore, which is the threshold limit for surcharge applicability, then you can check marginal relief, guys. So how do we check it? So we have three steps here. I will just name it. 1 second. 1, 2, 3. Yes. Yes, we are done, almost done, guys. Pay attention, pay attention. I know you are tired. You and I am. Okay, but let us finish it off. Total income you take first, then tax on total income, and surcharge would be applicable. That is why we are checking the marginal relief. Okay, add surcharge, you will get total. But don't take health and education cess here. Health and education cess will come only in the third step, guys. Please be careful. Okay, na? Yes, sir. Chalo. So you'll get total here. And this is normal calculation, nothing special in this. Okay. Second one is important. This we will do only when marginal relief is available. Okay. First calculate in the second step. Tax on the limit which is crossed by the assessee due to which surcharge is applicable. It might be 50 lakh, 1 crore, 2 crore, 5 crore, 10 crore or any amount. Is that clear? Yes. Add surcharge if total income crosses the second or higher limit. Guys, here surcharge will come only if the total income of an assessee has crossed second or higher limit. If it has crossed first limit, then there is no surcharge. Clear? What is it? I will explain you. Don't worry, numerically. First, let us understand the steps. Next, add total income minus whatever limit you have taken here on which you have calculated tax. Reduce that. Clear? In simple, total income in excess of the limit which is crossed. Okay, sir. Then add up all these three, take it as B. Now compare A with B. Compare A with B, take whichever is lower. Whichever is lower. And if B is lower, assessee will get a marginal relief to the extent of difference between A and B. To the extent of A and B. To the extent of difference between A and B. Sir, what if by chance, if A is lower? If A is lower, which is our normal calculation, no relief. No relief. In that case, sir, if I do A minus B, I'm getting negative. Guys, relief cannot be negative. Please be careful. Clear? Relief is available only when B is lower. B is lower, guys. Is that clear? Because A is our regular calculation. If that itself is lower, then no need to check, or no, there is no relief available, guys. Got it? Yes. So whichever is lower, we will take plus 4% health and education cess we need to pay to the government, which has to be rounded up to nearest 10 rupees. Okay. Now please observe. Let me explain with an example. Assume, guys, the total income of an assessee is 51 lakh, which is marginally more than 50 lakh. Should we check marginal relief? Yes, sir. So what is the total income? 51 lakh. Tax on total income would be how much? You calculate whatever is the rate applicable to the assessee. Yes, sir. Then surcharge would be at what rate? If it is more than 50 lakh, it would be at 10%. Calculate. Then take total. Fine. Keep it aside. Then come to second step. Tax on what is the limit crossed by assessee? 50 lakh. Calculate tax on 50 lakh. Will surcharge come here? No. Why? If the total income is exactly 50 lakh, no surcharge, guys. Only if it is more than 50 lakh, surcharge will come. So, if the total income of an assessee has crossed the first limit, then no surcharge. Because we will take the tax year exactly on that figure. If it is exactly 50 lakh, then no surcharge. Is that clear? Yes. Then total income minus 50 lakh. How much is that? 51 lakh is the total income minus 50 lakh. We will get 1 lakh. Okay. Add up this and this, you add up. This will anyway not come. Okay. Yes, sir. Then we'll get B, compare A and B and continue with the regular calculations. Okay, now? Yes. Okay, sir. Next. Sir, what if total income? Just a minute. What if total income is 1 crore 1 lakh? 1 crore 1 lakh. Okay. Calculate tax on 1 crore 1 lakh and here surcharge would be how much? 15%. More than 1 crore up to 2 crore, 15%, right? Yes, sir. Then here we need to calculate tax on 1 crore, the limit which the assessee has crossed. Yes. Now, this step is important. Will surcharge come here? Yes. If the total income is exactly 1 crore, more than 50 lakh up to 1 crore, what is the surcharge rate, guys? 10%. So here 10% will come. Whatever tax you have calculated here, on that 10%. Hope you understood. Because 1 crore is the limit which is crossed by the assessee, which is the second limit. Got it. So, on whatever figure you calculate tax here, if the total income is exactly that much, is surcharge applicable? You check. If yes, add surcharge here. And whatever rate of surcharge is there, that has to be calculated on this figure. Clear? Yes. Then here total income is 1 crore 1 lakh minus 1 crore. 1 crore here is the same figure which we have taken. Here we have to take it. Clear? Yes. How much we get? 1 lakh. Now add up all these three. We will get B. Compare B with A. Take whichever is lower plus 4% health and education cess. Is that clear? Yes. Now you might also ask me, sir, you told we need to apply these steps only when total income is more than the threshold limit for the applicability of surcharge by a small amount. What if it is by a bigger amount? For example, assume total income is, guys, 70 lakh. Then definitely A will be lower. Why? Because this figure you will get more, 20 lakh. And obviously this too also you will have. Okay, this will not come, surcharge will not come. Okay, so when you add up both of this, B will be more than A, guys. Clear? Assume it is 80 lakh or 90 lakh also. So this figure will increase actually in that case. So automatically B will be more than A. There is no relief available. If B is more than A, that means A is lower. We need to take it here, which is our regular calculation. No relief, nothing is available. Is that clear, guys? Yes, sir. Fine. I have some questions. Quickly, I will go through it, guys, on relief. Actually, this is on partial integration. I have tried to give this question in my question bank to confuse the students. You can just observe here, Mr. Asim is engaged in the business of roasting and grounding and is not doing any growing. He is only roasting or grounding. 100% of the income is agriculture, non-agriculture income. So should we apply the partial integration here? No, sorry, we need not. Sir, what if the assess is growing as well as roasting and grounding? Then we need to segregate how much is agriculture, how much is non-agricultural income, and then apply the partial integration tax. Here, but here he is doing only roasting and grounding. That means 100% will be non-agriculture income. And I have given this question immediately after partial integration. And in my regular class, most of the student will get trapped in this question. They will apply all the percentage, do the segregation of agriculture income, non-agriculture income, and then calculate the tax. I'll just give the time for them to solve this question, and most of them will go wrong in this. Clear? Yes. So you have to be very careful when you're reading the questions, guys. Sure. So you can see here, Mr. A is a individual who is aged 42 years, has a total income of 51 lakh. So we are supposed to calculate tax as per default regime and optional scheme. And he has entire income as normal income. Okay. So 51 lakh, calculate tax on that. I have given it your working note. I need not explain this, guys. We already discussed this. 11 lakh 10,000 we will get on 51 lakh. Okay. Yes. Next, surcharge would be at 10% on 11 lakh 10,000. So we will get 12 lakh 21. Keep it aside. Step 1 done. Then tax on, what is the limit crossed by the assessee? 50 lakh for surcharge applicability. Yes, calculate tax on it on 50 lakh. Similar to this, instead of 51 lakh, it would be 50 lakh. Okay, you will get 10 lakh 80,000. 10 lakh 80,000. I have given the working note here. Okay, so then will surcharge come here, guys? No. Why? If the total income is exactly 50 lakh, no surcharge. Only when it is more than 50 lakh, surcharge would be at 10%. Okay. Then add 51 minus 50 lakh, which is 1 lakh. So 1180. Compare both, whichever is lower, B. So is relief available? Yes. So whichever is lower is 1180 plus 4% says the assessee has to pay it. Then relief is to the extent of difference. To the extent of difference. Now if assessee is following optional scheme, then what? So then what? You can see here. Okay, so similar guys, similar steps, only the slab rates would change this part. Okay, yes. Whatever we have got in working note 3 and 4, we have to get it here. So then compare A and B, whichever is lower we need to take, whichever is lower is 14 lakh 12,500. So relief is available here also. Relief is available here also. Let me tell it, guys. Now, whether question is asked on this or not, but let me just specify. Assume out of 51 lakh, 11 lakh is special income. Any special income. What should we do, sir? In that case, first calculate tax on special income, guys, here. Then remaining normal income is how much? 41 lakh. Calculate tax at slab rates. Sir, what about here? This is very important. At this stage, out of 50 lakh, first consider 11 lakh as special income, remaining 39 lakh as normal income, guys. Remaining 39 lakh as normal income. I repeat, out of 51 lakh, let us assume 11 lakh is special income and remaining 40 lakh. 40 lakh is normal income. Okay. So in the first step, first calculate tax on special income 11 lakh and remaining 40 lakh normal rate. That is slab rates. Okay. Whereas here, it is not 51, 50, right? So should I take special income first or normal income? Special income. So first calculate tax on 11 lakh, then remaining 39 lakh will be normal income. Taxable at normal rate. Is that clear? Normally when they ask question on the marginal relief, they may not include special income and all. If at all, if they include, please consider accordingly. Is that clear? First calculate tax, especially here. This is anyway you guys can manage because that is normal calculation. But here in this step, first consider the special income. Over and above that, whatever is there, you consider it as normal income. Is that clear, guys? Yes. Then one more. Yeah. Here the assessee is aged 65 years. We are supposed to calculate the tax in the most beneficial way. And the total income is 5 crore 1 lakh. 5 crore 1 lakh, which we'll assume is completely normal income. It is given here. Completely normal income. Okay, sir. So under the default regime, guys, it is more than 5 crore. More than 5 crore. What is the surcharge rate? Guys, please be careful. The highest rate of surcharge under default regime is 25%. When is it? When the total income is more than 2 crore. When total income is more than 2 crore, whether it is more than 2 crore, 5 crore, 10 crore, doesn't matter. Surcharge rate is 25%. Is that clear? Yes. So the highest limit is 2 crore. And has it crossed? Yes. Has it crossed by small margin or bigger margin? Big margin, guys. More than 2 crore, how much is there? 3 crore 1 lakh. Clear? Because the 5 crore limit is not applicable under default regime. Hope you guys are aware of it. Clear? I will just show you. Just listen here. Yeah, you can see here. So under default regime, more than 2 crore, it is always 25%. 5 crore limit is not there. Whereas under optional scheme, if it is more than 5 crore, it is 37%. So under optional scheme, we can check relief. Whereas under default regime, no need to check relief. Why, sir? Because the total income of an associate under default regime has crossed 2 crore by a bigger margin. So relief will not be available. Even if you check relief, that in the second step, no. Just a minute, I will show. In this step, you need to add 3 crore 1 lakh. So automatically B will be more than A or A will be lower. So no relief will be available, guys. Okay, sir. Sure. So you can see total income is 5 crore 1 lakh. Calculate tax on that. Working note I have given. So the gross tax comes to 1 crore 46 lakh 10,000. Take it. Add 25% surcharge, not 37, 25. We are doing it under default scheme, guys. Please be careful. Oh. Then 4% health and education says the total tax liability under the default regime is 1 crore 89 lakh 93,000, guys. Okay. Now let us check it under optional. Okay. Under optional regime, is relief available? Yes, will be available because it has crossed 5 lakh by a small margin, guys. Okay. So first step, total income is 5 crore 1 lakh. Calculate tax on that. I have given a working note for it. Just have a look into it. It comes to 1 crore 48 lakh 40,000. Take it. Yes. Then surcharge at 37% because it has crossed 5 crore, guys. Please be careful. Yes. So the total comes to here 2 crore 3 lakh 30,800. Keep it as A. Come to second step. Tax on. What is the limit the assessee has crossed? 5 crore. Calculate tax on 5 crore. Working note. And please be careful here. The base case limit is 3 lakh. Why, sir? He is a senior citizen. That is one of the important key thing. Assessee is a senior citizen people. Okay. Yes. Under optional scheme only it is 3 lakh. Yes. Whereas under default regime, normally always 4 lakh, irrespective of the age. It comes to 1 crore 48 lakh 10,000. Okay. So here only the figure will change. 5 crore. Here it was 5 crore 1 lakh. Whereas in the next working note, it is 5 crore, guys. Okay. That's the only change. Okay. So tax on 5 crore, you'll get 1 crore 48 lakh 10,000. Here is surcharge applicable? Yes. If the total income is exactly 5 crore, what is the surcharge rate, guys? More than 2 crore up to 5 crore, it is 25%. So calculate 25% on this. Very important step. Very important step. Is that clear? Yes. So then we will add total income minus 5 crore. That is the limit what is crossed here. So we will get 1 lakh. So now we are deriving B. How much is that? 1 crore 86 lakh 12,500. So whichever is lower, we need to pay. So this is lower, guys. Plus 4% cess. We will pay it. Is relief available? Yes. As B is lower than A, to the extent of difference, marginal relief is available, guys. Is that clear? Yes. So yes, that's all. So especially this part, please be careful, guys. Whenever the total income of an assessee is crossing the second or higher limit, there will be surcharge in the second step. Got it? Yes. And I have some more questions on marginal relief and all. You guys can just go through it, guys, including for companies I have given. Okay, because I will not be able to discuss each and every question. Hope you guys understand due to time constraint. And I would suggest you please download this and if possible take a printout of this question bank and try to solve all the questions. Okay, if not you are not able to solve all the questions, means at least go through them and pick some important questions which you feel interesting and please solve them, guys. At least 3 to 4 questions you solve. Got it? Because you have to get used to the calculation before going to the exam hall. In the exam hall, you should not get stuck in between when you are calculating. Got it? Yes, sir. Even we have good number of additional questions, okay, on this chapter. Please go through all of them, guys. Yes, finally, we are done with the concept of marginal relief. So we have covered all the topics with respect to tax rates, guys, including the tax rates applicable on special income, rebate concept, surcharge, then partial integration and marginal relief. I have given few assumptions here. Guys, you will make the following assumptions only when question is silent about it. Sir, what are those? If the residential status of an assessee is not given, but if it is required for you to compute the tax liability, please assume he or she is a resident or any assessee is resident. Then if by chance if age of the individual is not given, assume less than 60. If it is specifically given, please follow it. If it is not given, assume less than 60. Then guys, if the question includes, they would have given, if question includes any special items like capital gains, casual income or undisclosed income and all, it would have been mentioned in the question. But no, sir, nothing related to special income is given in the question. Assume entire total income is a normal income, which is taxable at normal rate. That is either flat rate or slab rates. Got it? Yes. Sir, what if the question is silent about the scheme to be followed by the assessee, that is slab rate assessee? In that case, you can assume that they are following default regime as per section 115 BAC, guys. So we are completely done with tax rates revision, guys. So now it is your duty. Once you're done watching this video, please make sure you guys go through all this and try to recall them. Maybe you'll, once you are studied, you close the book and try to recall all the rates, guys. Take care.